Good afternoon and welcome to Canadian Ag Markets. My name is Brian with ICL Agriculture Markets. Today, or before we start off with what happened in the market today, just want to give a little shout out to our Canadian hockey players. Both the women and the men won their games today, 5-2 nothing. The women blanked Finland 5-0, and our men secured a 5-0 against Czechia. So good start to our tournament here. Um, I have been keeping one eye on the future screen and one eye on the TV today because it was an exciting day. Also, to show my Canadian pride a little bit, I've worn this T-shirt before in this video, but it's a T-shirt from a company called Corporal for Life. We being a military family here, we like to support our troops and our veterans. If you buy these shirts or any of their apparel, 10% of the profits are donated to organizations helping veterans and first responders in Canada. So I'll leave the link for this in the description. I'm not sponsored or anything like that. I just happen to like the company and like what they stand for. All right, let's get into what happened in futures markets today. Canola gained $5.10 to finish at 667.80. Minneapolis wheat gained 7.25 cents to finish at 578. Kansas wheat up 15 and a half cents to 554. Chicago wheat up 15 and a quarter today at 552 and a half. Soybeans gained 13.25 to finish at 1137.25. Corn up 3.75 to 431 and a quarter. Bean oil up half a cent at 57.54. Canadian dollar lost 19 points, now trading at 73.47. Live cattle shed just a tiny bit, 33 cents to 240.65, and feeder cattle shed about a dollar to 363.63. I was reading that right. All right, let's talk a little bit about wheat and what's happening in wheat today. We saw a pretty good technical push above some technical indicators today. We saw it go above here. Maybe I will get my little trusty laser pointer here. We went not only above the 20-day or 200-day moving average, but ahead of the high from early November. We also saw it move out of the Bollinger Bands. And the reason I put this on there is just because this trade has been very sideways over the last little while. And Bollinger Bands kind of showcase it calculates volatility and directionality. And as they narrow, it signals that the market is more neutral. But now that we've broken out below that, I think that the Bollinger Bands will expand, which may mean we may see some higher volatility here for the Kansas or for the wheat markets in general. Now, what was the driver of this? We haven't seen confirmation yet, but I don't think it's a coincidence that we saw the drought monitor come out today from the USDA, which saw some interesting changes to the winter wheat areas in drought. Here is the map, and if you kind of look at this map, it doesn't look very dire, as this big area, which is primarily hardwood winter in Kansas, is relatively untouched. But Oklahoma, northern Texas, Washington up here, Montana, and the Mississippi Delta wheat areas are all being affected. So when you kind of look at it, I'll show a couple of different perspectives to look at here. This is all published in the Ag and Drought Monitor as well. Kansas, sure, it's not experiencing that much drought. It contains about 21% of the winter wheat grown in the US. But these next top 10 states are getting worse. So Washington currently 55% in drought, Idaho 88, Montana 60 with some quite extreme drought conditions in Montana, Oregon 57, Texas 52, Colorado 51, and then up into Illinois, we get big numbers again. So the threat of drought is rising again. Here's another way to look at this chart. This chart shows kind of the increase or decrease in severity. Moderate or more intense drought is the least threatening. So but even so, this moderate to more intense drought has risen 11 percentage points since the start of December, from 34 to 45. But what we've also seen is a rise in the more severe or more intense drought, 7 percentage points. That's just in the last 4 or 5 weeks during this calendar year. And the extreme drought, which was kind of hugging around that 3% range, has ticked up this week to 4%. So I think the market's getting a little bit of spooked here about the trend in drought. So here is the Chicago. Just kind of wanted to show this as well. I do believe that there's probably some short covering being triggered here. The CBOT wheat shorts were 81,500 contracts deep last Tuesday, and shorts had been reducing their exposure as we went forward. I'll show also my monitor here for today's trade. You could see here between the May and the March, the volume on the March is larger. We're larger at 145.8 today, but the open interest in the in the May is larger. So what this signals to me is that there are traders who are exiting their positions in the March, likely covering their shorts in the March and not replacing them as aggressively in the May. So this is this is a signal anyway of some short covering in this market, which explains some of the strength today. All right, let's get into canola here because I think there's some interesting things happening today. Over the last couple of days, we've seen some interesting trade, even though it doesn't look so much interesting on these charts here. But what we did see today was a clear test of the November 18th. I think those are November 18th highs. They were rejected on the May. This is the contract with the most volume and open interest. This is likely being caused by soybean oil. We saw another new high in soybean oil today after it broke through resistance last on Monday, I guess that would be. So we are continuing to see strong soybean oil performance. But what I do find interesting is when you look out into the deferred months for canola, we actually in the July contract, we saw a move above the 20-day moving average over the last couple of days. And then today it broke to new highs. I do find this interesting. It's hard to tell if this means that it's a bullish push above or not. I do find that the because the front months aren't doing the same is why I'm feeling curious about that. One thing I find interesting is this canola yield curve right now. As you can kind of see here, there is carry into the July, but what's interesting to me is we have the May and the NOV trading very similarly, and we have the July and the January trading very similarly. So, you know, I do find that interesting. I think that it might be a good idea if you have quite a bit of old crop canola left in the bin. That once this comes up and reaches that 700 level, that would be a good hedge. And whenever that happens, whatever this November contract here is, that might be a good hedge for new crop as well. And if you don't need the movement or cash flow for November delivery or yeah, to hedge off the November and deliver and get paid off the November, I think the January might be a contract to look at as well, particularly if it continues to kind of track the July. So just kind of some insider insights there into what we're thinking on these canola markets as they rise and the calendar spreads get a little bit wider. Uh, let's look at soybeans here now. Soybeans saw another really good day. There's concerns over the South American harvest being delayed. Although that crop is large, it is being delayed by rain, which is, anytime that happens, you'll generally see or you won't see weakness in prices. But interestingly, we are kind of reaching up towards that 1050 area. And then after that, there's a 1070 area. And as you can see, this isn't the strongest level of resistance here. So, but it is kind of grinding higher towards that. I like what I see there. I think we will see an 1150 test at some point, unless there's some kind of headline or black swan event that would prevent that from happening. But definitely the path of least resistance right now in the soybean market is up. We're also seeing some good stuff in the corn market. We did see it pop above the 20-day moving averages here. This kind of orangey line is more of the EMA, which is a weighted moving average, but it's still trying to push higher. We can kind of see now that there is a trend forming here. And I think that's positive. We could continue to reach higher if the lows continue to be higher. So we're seeing a couple of higher highs and a couple of higher lows. Those are good signs to grind back this corn market to where it was before the big USDA surprise in January. All right, a couple of quick hitters to finish off this market. U.S. commercial crude inventories rose by 8.5 million barrels in this last week, finishing February the 6th. I think that may have pulled crude oil back towards these 20-day moving averages here. And that also has kind of sunk the Canadian dollar today, although some of that Canadian dollar weakness is a result of equity weakness as well. So, yeah, just some quick hitters there on energy and currencies there to end the day. That is all we have for you today. If you are not a subscriber to this YouTube channel, please do so right now by hitting that subscribe button below. You can even hit the bell if you want to get notified when we have new videos that come out. All right, thanks for listening. We'll see you again tomorrow.